reached the voicemail for Kyle Scholl. Please leave a message and I'll get back to you as soon as I can. Thanks so much. Have an awesome day.
Hey Kyle, just giving you a call. Wondering how much to throw at my Roth or traditional IRA. Give me a call back. Bye.
Hey Kyle, what are your thoughts on doing a Roth conversion? Give me a call.
Okay, we're talking tax bracket management today. At the end of this video, you'll have a better understanding of how to answer some pretty simple financial planning questions that I used to get all the time. Questions like,
should I contribute to my pre-tax traditional IRA or to my Roth IRA?
How much should I pull out from my IRA?
Should I do a Roth conversion?
Okay, let's get to work. What's up guys, I'm Kay Scholl. Welcome to another financial awareness video. So what is tax bracket management? Well, what it is not is rocket science. And what it is exactly what it sounds like. It's taking an intentional approach to decide which of the marginal tax brackets you want to fall into each year during your accumulation years or throughout retirement during your distribution years. It's simply taking some time to do basic math and planning each year. Couple things I'm taking into assumption during this video. 1, I'm assuming you already have a financial plan. 2, I'm also assuming that you are living well below your means so that you have some surplus funds each year to even be asking yourself these questions. If you don't have a financial plan or you are not living beneath your means so that you have extra money, then this video might make you feel like you're a little behind, but don't worry, we all started somewhere. Let's go over a few examples. Actually, hold on, before we go into a few hypotheticals, you may have picked up on this from a few of my other videos. We are of the mindset that federal income tax rates will be higher by the time my wife and I begin to live off of our portfolio. So as a general rule of thumb for us, we are putting as much as possible into our after-tax Roth accounts. But many people like to get the tax deduction right now to lower their tax burden this year. To me, it's a little bit like playing chess versus playing checkers, but to each his own. For the sake of argument, let's not talk about write-offs and business expenses, just to keep this easy to follow. Should I contribute to a traditional pre-tax IRA or to an after-tax Roth IRA? And a distant third cousin to that question would be, should I contribute to my after-tax Roth 401k or my pre-tax 401k? Here's a hypothetical. Let's say you're single, you make $60,000 per year, and you put 5% into your work 401k to get the full employer match, and you're trying to get your taxable income below $40,000 to prevent being in the 22% tax bracket. Because 12% is pretty sweet, but that's quite a jump from 12% to 22%. Okay, so $60,000 minus $3,000 for your pre-tax deduction brings us to $57,000. At this amount, you're still under the $65,000 income phase-out limit for getting the traditional IRA tax deduction. We know you're single and will be getting the $12,400 standard tax deduction for not itemizing, which brings you down to $44,600. Therefore, based on this math, you should contribute approximately $4,600 into your pre-tax traditional IRA, and voila, you now have just managed your tax brackets and are down to 12% instead of 22%, despite being well above the threshold and making $60,000. Quick side note, whether it's this year or really any year you suspect you're hitting your targets at work to make you eligible for that end of the year bonus, keep an eye on the cutoff dates for your 401k contributions during the actual pay period you think you'll be paid out your bonus. If you can time it right, you could adjust your 401k to prevent a huge tax bill from your bonus check during that actual pay period. If you don't make this adjustment towards your 401k or don't make any tax withholding adjustments for that specific pay period, then you might be shocked with how big of a tax bill comes out on that bonus check. And maybe as a result, potentially might get a larger tax refund next year when you go to do your taxes. So you can start to see how you could play some games here. Hey, if you're getting any value from this video, do me a favor and tap that like button and let me know in the comments below if you have any questions. Although I did spend some time in the financial services industry, I am not your financial advisor or your CPA, and this video is for entertainment and educational purposes only. How much should I pull out from my pre-tax accounts? If you're a retired firefighter living off of your pension and Social Security, you might be asking yourself this question from time to time. Or maybe you're building up assets in both pre-tax and after-tax accounts so that you'll have options to pull from either account during retirement. Let's say you're looking to pay cash for a car during retirement and need to liquidate $25,000 from either your Roth IRA or 457 deferred comp account. If you are flirting with any of these tax bracket thresholds, the general rule of thumb would be to work with your CPA and consider pulling funds from both, or only pull enough funds from the pre-tax 457 deferred comp account so that you don't get bumped up into the next tax bracket. Alternatively, if you can properly plan this out by exercising some emotional and financial discipline, you could break up your distribution between 2 tax years. If you know you are planning to buy a car in the following March, then maybe you pull $15,000 out in December and another $10,000 out in February so that you're not hit with as big of a tax burden by being bumped up into the next marginal tax bracket. And voila, you're managing your tax brackets. Should I do a Roth conversion? Very similar to the math we've done before, and you're starting to see a theme here. If you are well inside the 22% tax bracket and not flirting with the 24% rate, then you can strategically consider converting some of your pre-tax traditional IRA dollars over to your after-tax Roth dollars. The downside of doing this is that you'll be voluntarily paying taxes on whatever you convert. But the benefit would be the funds would be able to grow tax-free instead of tax-deferred. Paying the taxes on the conversion out of pocket would be ideal, but if not, you could always pay them from the conversion. Huge side note here, if you really want to be a pro with your financial planning, try to time your conversions around the same time as when the market dips or has a pullback. Nobody could have predicted what happened in March of 2020, but if you have a dialed-in financial plan and you have these topics on your mind each year anyway, that would have been a great time to do a conversion, because then all that upswing growth would have been inside your Roth, growing tax-free. So as the market continues to fluctuate up and down over the years, keep an eye on that strategy and try to take advantage of it if you can. As you continue to grow your financial planning knowledge, one of the things that will help you make strategic financial planning decisions is knowing the difference between your effective tax rate and your marginal tax rate. So check out this video right here, or I don't know, you might like that one instead. I appreciate your time. See you in the next one.